Good morning, everyone, and thank you for joining us on Morning Markets. Today we'll discuss some of the key events over the past 24 hours and how they've impacted certain areas of asset markets, in particular currencies and bond markets. Firstly, just looking back yesterday at how equity markets performed, really not a lot of direction from markets over the course of the past 24 hours, where we did see, I suppose, markets really taking on board the news flow around what the ECB is doing, what's happening in terms of Brexit, and what's happening in the US in terms of the unemployment situation there. So if we just look at some of the broad equity indices and how they performed yesterday, we saw the Euro Stoxx 600 down about 0.4% over the course of the day. If we look in the US, the S&P 500 was roughly flat over the course of the day. Nasdaq did gain. Nasdaq was up about 0.5%. And within the US, it's still quite evident that the small and mid-cap area is garnering attention, with the Russell 2000 up about 1.1% on the day. Just looking at some of those news events from yesterday, the first of which is the one that we've been flagging over the course of the week, what was going to happen with the ECB, and as expected, no change to rates, but what we did get was an expansion of the emergency response programme of some 500 billion euros, and that has been extended through to the end of March 2022. There's a number of other programmes that are part of that, but clearly ongoing support from the ECB from a monetary perspective over the coming number of months. Within the documents that the ECB released yesterday, they also updated their forecasts in terms of the economic growth outlook for 2021 and beyond. Slight movement in how they're thinking about the pattern of recovery within the Eurozone. So revising slightly lower their GDP expectations for 2021 to some 3.9% from previously a 5% growth rate. But then that growth rate's just been pushed out further, so a stronger recovery into 2022. And that's just symptomatic of where we've got to today with the lockdowns, etc., and the impact that that's had on the speed of the recovery and the recovery into 2021. The other important thing yesterday, just from an EU perspective, was agreement on the EU budget, and also the removal of the veto from Poland and Hungary, and that's then released that budget to be spent alongside the support programmes that come with that as well. So that was a positive, and we did see that playing out then into other asset markets when we think about how the euro performed yesterday. So the euro strengthened a little bit yesterday. It strengthened about 0.5% relative to the US dollar. Again, the other side of that to an extent is what's happening in sterling. Sterling did fall about 1% or so yesterday, but then gained over the course of the day to close down about 0.4% relative to the dollar. That weakness primarily attributable to comments from Boris Johnson, where he did suggest that there was a possibility that we could be leaving the EU without a trade agreement come the 31st of December. Given that we've got the deadline for discussions on Sunday, although reading some reports this morning, it does seem that, again, as to be expected, that's a moving feast as well, so it might not be the deadline and we might not have a conclusion to this on Monday when we're discussing it. I just also wanted to touch on what some of that activity meant for the bond market, and in particular the gilt market here in the UK. So we did see gilts coming in quite a bit yesterday in the UK, with the 10-year gilt moving in from about 0.8% to 0.21%. And looking at the shorter end of the curve, looking at the 5-year bond there, what can we see? Well, they're increasingly trading with a negative yield. So the yield on the 3-year is now 0.12% negative from negative 0.01 at the beginning of the month. So a step down in yields there. And what does that indicate? It indicates that market participants, I suppose, are expecting something from the MPC at their next meeting. they kind of ruled out, or not ruled out is maybe too strong a term to use, but they're reluctant to move rates negative. So it probably speaks to an expansion of the quantitative easing program over the coming number of months. And that is, over the past months of this year, has been met with fiscal support as well. But it's going to be interesting to see how that plays out over the first half of next year, whether we do have those areas working in tandem, or if it's very much focused on the monetary side and the support that the MPC can provide. The other point just around regulation in the UK, we had the Prudential Regulatory Authority last night publishing guidance for the banks and how they can potentially return to paying dividends. That's an important aspect. The income that the financial services sector provides in terms of dividend income is an important characteristic of the UK market, and it's good to see that dividends being allowed to return, albeit there does appear to be quite restrictive criteria around that. But we'll see how those stocks react today, and we'll report back on that on Monday. That's it for today. Many thanks for joining us. Please watch out for our weekly podcast, which will come out this afternoon, and join us again next week. Many thanks.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.